Hello, and thank you for your consideration of Strategy's announced Perpetual STRD preferred stock. Joining us from Strategy is Executive Chairman Michael Saylor and Chief Executive Officer Phong Lee. Here you will find a summary of key terms for the STRD offering. Should you have further questions, please reach out to your representative at Barclays, Morgan Stanley, TD, or Moelis. With that, I will turn it over to Phong to begin the presentation.
Thank you, Matt. Thank you, everyone, for joining our webinar today and watching this recording. We are launching STRD, the third of our preferred offerings, and we're doing it in a very strong market environment. As you can see here, Strike since launch at $80 has increased 29% in a period of about 4 months. And Strife since launch has increased 22% since launch. This is in comparison to 6.1% during the same time period as Strike for other preferreds and negative 4.6% for other preferreds during the same period as Strife. So I think it's a great market environment to be launching our third perpetual preferred offering. Especially if you look at the last month, we have seen both of the perpetual preferreds, Strike and Strife, perform up 13% and 15%. So a strong last month for each of these offerings also. Now, if you take a step back and look at our annualized asset performance of MSTR, we've seen 103% returns over the last 4 years. That's essentially double or almost double the returns of Bitcoin, quadruple the returns of the Mag 7, and nearly 10 times the return of both the S&P 500 and gold. If you take a look at us over that same period of time, since the beginning of the Bitcoin standard era, we've outperformed all major assets, the big tech, all assets against the S&P 500, also 2,885% returns since the beginning when we adopted our Bitcoin strategy. And one other view over the last 3 months, with a lot of change and turbulence in the macroeconomic environment and global markets, we've seen MicroStrategy beating again the entire Magnificent Seven and many of the other indexes that we compare ourselves to. Our convertible bonds, since we've issued them, have also performed well. In fact, on a blended basis, have returned 65%, which is slightly better than the returns of Bitcoin during that same period, 59%. And overall, across multiple different metrics that we measure ourselves, annualized return, we're number one versus the S&P 500. In the options market, also number one against IBIT and against the crypto complex. We mentioned before the Bitcoin standard era return, 2,885%. We're the number two most volatile stock against the S&P 500, number 6 in terms of open interest against all of the stocks in the S&P 500. And when compared to take our open interest as a percentage of our market cap, we're number one again versus the S&P 500. We're the largest corporate holder of Bitcoin in the world with $61 billion in Bitcoin net asset value. And our trading volume compared to the S&P 500, we are number 10 against the S&P 500. And if you take a look at that trading volume as a percentage of our market cap, 6%, that takes us up to number 3. So we recently announced our $42 billion capital plan, and we're happy to say that we're 36% complete on that, 56% through our equity plan, $23.4 billion issued since we announced this plan in October of 2024, and 16% through our fixed income plan. And that's what part of the reason we're launching STRD is on the strength of Strife and Strike, and to be able to approach the target of the $42 billion, we think Strife is quite important. Another thing to note is we launched ATMs at the market offerings for both Strike and Strife. And to date, we have raised $316 million in Strike, $49 million in a short period of time of Strife. And so we believe that there's enough liquidity in the fixed income market and in Strike and Strife that this is an appropriate time to launch STRD. And our intention is once after we IPO STRD, we'll also at the appropriate time launch an ATM on STRD also. If you look at our year-to-date performance on BTC yield percentage and BTC dollar gain, two KPIs that we measure ourselves against, we recently updated our BTC yield target to 25%. And year-to-date, nearly halfway through the year, we're at 16.9% BTC yield. On the BTC dollar gain, we have a $15 billion target, and we're also more than halfway through at $8 billion compared to our target of $15 billion, nearly halfway through the year. In terms of our current debt structure and our coverage on that debt, we have about $61 billion of total Bitcoin asset value and $5 billion of convertible debt that is currently out of the money. And so when we look at it from that point of view, $61 billion of Bitcoin net asset value and $5 billion of other money converts, we are well covered, 12x coverage on that. The other question we often get is what about the dividends? How do we pay the dividends, and what is the ability to have coverage on the dividends from our current STRD, current Strike and Strife Perpetual preferred offerings? And as we add STRD to the complex, how does this look? Well, if you take the same $61 billion of Bitcoin asset value, take away the $5 billion of out-of-the-money converts, that's about $56 billion of coverage. And with the needs that we currently have in terms of covering the dividends for Strike, Stripe, and eventually STRD, we have 290 years of dividends that we can pay using the Bitcoin that we have. And if Bitcoin was to decline by 75%, we still have 37 years of preferred dividend coverage using our Bitcoin asset value. So we think we have a lot of coverage for the dividends and potential dividends of our perpetual preferred offerings. If you look at our total capital structure, I mentioned the $61 billion of Bitcoin value. That's one way to look at it, and looking at our complete debt complex. You can see here we have 50 billion of that is essentially unencumbered by any of our debt. The entire $61 billion unencumbered. But if you take out the debt that we have, we still have 50 billion remaining. You look at it from an equity perspective, currently our market capitalization is about $112 billion. And taking away, again, the $10 billion or so debt, we still have $102 billion of equity to cover the debt that we have on hand. The final point I'll make, or the next to final point I'll make, is our convertible debt, right? And the risk profile that the convertible debt provides. And what I'll mention here that I want to point out is that the $8.2 billion of convertible debt, first of all, some of it is fairly long dated all the way out to 2032, which is 7 years from now. And second thing I'll point out is the interest on the convertible debt is really now 0.421% on a weighted basis is our average annual fixed interest rate that we have for convertible debt. Last thing is a lot of folks ask, well, how do we think about what Bitcoin price might approach? And so what we have here is we've assembled a view of all of our analysts and what they project for Bitcoin price in their different models, right? And you can see here the average price projection for 2025 is $161,000, 50% up from where we are today. And as you look out to 2026, 225,000, the 3-year projections, 257,000. And even one of our analysts, Bernstein, looks at this 8 years out, $2033 million Bitcoin price. So those are some reference points that folks can think about when they consider investing in STRD and what might become of Bitcoin and what might become of MSTR. So with that, I'm going to hand it over to Mike, who will go into more detail with our new offering, STRD.
I'm very excited to introduce STRD to all of you today. STRD represents our third preferred stock that we have brought to the market so far this year. STRD is a preferred stock that will yield 10% perpetual non-cumulative dividend. It's a quarterly cash dividend. It's non-callable for life. It's going to be backed by about 6x Bitcoin collateral coverage at the current Bitcoin price. So what we refer to as a BTC rating of 6. Why are we bringing Stride to market? Well, we're building out the yield curve for Bitcoin-backed credit instruments. So Strife is our senior perpetual preferred, and for a Bitcoin believer in Bitcoin-backed credit instruments, then Strife is meant to be something similar to an investment grade. It'll be the crown jewel of our preferred stack. And our aim is for Bitcoin credit investors to view that as investment grade, and we'll work to over collateralize that, and to make sure that that is always senior to every other preferred instrument we bring to market. Strike, of course, is a convertible preferred, so it's partly dividend bearing and partly it has conversion right to MSTR common. Stride is really targeted at the high yield market. It's our high yield credit instrument. And if you look at it on this slide, you can see that one of the benefits of Stride is we expect it to yield more than Strife. We expect it to be the highest yielding of the preferred equities that we offer to the market. And we also expect it to be very long duration. So you can see compared to high yield loans or high yield bonds, this will be a longer duration instrument because it's perpetual with no call. And compared to Strike or to Strife, it should be a higher yielding preferred instrument. And of course, you could find a long duration U.S. Treasury bond, like a 30-year Treasury bond. But our goal is to offer a combination of long duration and high yield for credit investors that are looking for that. If we look at it, charted seniority versus volatility, you can see our most senior instrument in our capital structure is Strife. And then you can see the next most senior will be Strike, and then Stride will be third, and then of course the junior security is our common equity. And of course, on a volatility curve, we've constructed the capital structure so that our common equity is going to be the most volatile. And that's important because people want to build derivatives and options and the like off of that volatile instrument. Strike should be the second most volatile. It has proven to be somewhat less volatile than the equity, but more volatile than Strife over the last few months. We expect Strife to be the least volatile because it is senior in the capital structure. It's the most senior instrument, and we would think that Stride will probably be somewhat more volatile. Now, we can't be quite sure about this until after we've observed it in the market for some amount of time. It's possible that Strife will become a much longer duration instrument, and there'll be volatility in the interest rate markets, in which case that might actually have a bigger impact on Strife than Stride. But we also think that the impact of Bitcoin moving around will impact the credit spreads and the expected risk of all these instruments, and that might have a greater impact on Stride than Strife. So this is our outlook right now. The one thing that's really important, though, just to observe, is that Strife is senior, Strike is junior to Strife, Stride is junior to Strike, and MSTR is junior to all three of these instruments. Here's a table that shows the three instruments, and what you can see is that so far we've got outstanding notional $1.069 billion of Strike. We've got about $899 million of notional Strife outstanding. This offering is targeted to start with a $250 million notional amount. All three of these are listed on NASDAQ. Strike and Strife are already trading. Stride should trade somewhere on NASDAQ with the STRD ticker. They've all got the same duration. You can see the dividend of Stride is 10% at par, just like Strife. The primary difference is where Strife is cumulative, Stride is non-cumulative, and where Strife is senior, Stride will be junior. That means Strife will have the higher BTC rating at all times. Stride will have a lower BTC rating than Strife and Strike. Having said all that, a 5.9x BTC rating is a pretty large amount of collateral coverage, almost 6x over collateralized. And you can see the comparison. Phong showed performance. What's extraordinary and what you pick up here is that both Strife and Strike have traded up more than 20% since their IPOs. In the same time period, a difficult macroeconomic environment where other preferred stocks have traded down approximately 5%. Stride represents the fourth gear in our BTC engine. And of course, the point of our engine is to generate BTC torque via surgical management of our ATMs in every single trading day. So the lowest gear in our engine is the common equity, and the second gear is Strike. Strife represents the third gear. Sorry, Stride represents the third gear, and Strife will be the fourth gear over time. And you can see we're doing daily rebalancing of each of these ATMs. As we rebalance the parameters of the ATMs, we let them run minute by minute programmatically. And then we tend to work to synchronize our BTC acquisition as we raise capital in the capital markets. And these four gears, they give us the ability to continuously generate BTC yield and BTC gain over time in all manner of market conditions. Sometimes all four of these gears will be turning, especially if MNAV is very high on the equity, if the high yield markets are very accommodating, if the more senior credit markets that we're positioning Strife in are accommodating, and if there's enthusiasm for a convertible preferred like Strike, we'll be selling all four at the same time. There'll be periods when we won't be selling or we won't be turning one of these gears or two or three. In extreme circumstances, we might shut down the entire engine and coast. But as a practical matter, generally, there's probably one or more of these gears that's going to be working, and we will be reacting to the capital markets daily and minute by minute as we operate this BTC machine. As you compare these instruments, Stride versus Strife, you can see they're pretty similar, except that one is a senior and one is a junior. You can see that the effective yield of Strife has fallen now below 10% because it is traded above par. And, our goal with Stride is to just create a higher yielding instrument and one that will appeal to investors that want the higher yield. We would expect that as the BTC rating of Strife increases, the credit spreads could improve. And we expect that as investors become more comfortable with our Bitcoin collateral, then that will be beneficial. And so, of course, that's good over the long run for our common equity. It gives us a more efficient mechanism, and it gives us a lower cost of capital. But ultimately, we'll have a lot more flexibility to raise capital if we have both of these instruments operating. If we weren't bringing Stride to market, if this offering was simply a secondary offering of Strife, we would be undermining the credit of Strife, and so probably the effective yield would, rather than continue to climb, it might be pressured or held stable. So, in fact, we think that it's better for the company to allow the high yield Stride at the same time as the senior Strife. And that gives us the ability to work both ends of the yield curve at the same time. Otherwise, there's not that much difference between the two, except for the fact that there's a cumulative dividend right to Strife, and there are enhanced governance features for Strife in the event that a dividend is missed. And those two things don't come along with Stride. This is a snapshot of our capital structure. And you can see we've got the converts at the top of the pyramid. They're most senior with the least risk. Then the crown jewel of our preferred is Strife. We have attached to it a $2.1 billion shelf registration. We expect to be very judicious about how we exercise that ATM. Strike, of course, is a convertible preferred, so you have some liquidation preferences. You have a dividend, and then you have a conversion right. Think of it as a Bitcoin fellowship with a living stipend. If for those who don't want the volatility and the leverage and the common equity, this offers them the chance to participate in the upside, but with more principal protection and with that guaranteed dividend stream, or the constant dividend stream that's geared at 8% of par. Stride is our high yield instrument, and we're starting out with this initial offering, but over time we're in a position to put another ATM on it, and I would anticipate that at some point we will attach a shelf registration and an ATM to Stride. Then below Stride, we have MSTR equity, and of course, we have our BTC holdings. Now, if we think about how Stride impacts all parts of the capital structure, Stride is improving the BTC rating of the converts of Strife and of Strike. So the more Stride that we sell, the more collateral there is for those elements that are senior to it in the capital structure. So in fact, we think that the market should perceive that Stride decreases the risk of the convertible bonds, decreases the risk of Strife, decreases the risk of Strike. It should be credit positive. If we grow this enough, it seems like it would be a driver to the compression of credit spreads of the above three. And certainly our plan is to improve the credit and improve the performance of those three senior instruments through delivering Stride to the market and growing the Stride preferred equity base. Now, if you look below Stride at the elements that are junior to it, we think that Stride adds intelligent leverage to MSTR. Stride is a way for us to raise additional capital without diluting the common. So it's quite reasonable that Stride could drive the MNAVs north. It could get us to a higher MNAV. Certainly, our plan is to use Stride to drive the MNAV to 2, to 3, or to 4, or beyond. And how would you do it? Well, intelligent leverage. And the intelligent leverage of Stride is that we've got the leverage of a bond, but the principal is not coming due. And then, of course, we are incurring the dividend obligation, but because it's non-cumulative, it's a much lower risk dividend obligation than, say, a convertible bond. A convertible bond principal does come due, and whatever coupon is an obligation. And Strife is much less risky and much more intelligent leverage than a bond because the principal doesn't come due. But the dividend is cumulative and there are penalty provisions. And so it is a more risky form of leverage than Stride. Stride gives us the ability potentially to increase our leverage ratio much higher than if we simply relied on convertible bonds or Strife. And if Strife does become or emerge to be viewed as investment grade, then it'll be sitting at a very different point in the yield curve, and it'll be in demand by a very different set of credit investors. And STRD will allow us to continue to appeal to a different set of credit investors, even if STRD does appreciate to investment grade credit spreads. STRD, of course, has another impact on our equity. When the equity capital markets are strong, STRD allows us to achieve a higher MNAV. But when the equity capital markets are weak, in the event that, say, our MNAV is less than 2 and we're not enthusiastic about selling equity, we could sell STRD in order to acquire Bitcoin until our MNAVs were to appreciate to 2, 3, 4, 5. So we can use STRD in order to support a much higher MNAV in lieu of using our equity ATM. Now, in an extreme case, where the MNAV were to fall to 1 or below 1 for the equity, STRD gives us the option to actually sell STRD and then buy our own stock back. And so this is both an intelligent form of leverage to drive up the premium that our equity trades at versus Bitcoin NAV. And it's also a great defensive mechanism in case there were a market dislocation and the common equity would trade below MNAV. A straightforward strategy for us to recover that would be to simply swap the STRD for the STRD exposure for the MSTR exposure, and capture that difference. It's a very easy way, right? For us to capture the discount and monetize the discount to the benefit of the common stock shareholders when we trade below MNAV, in the same way that we monetize the premium from time to time when we trade at a substantial premium above MNAV. And of course, the last point worth making is STRD is very accretive, or it's very bullish for BTC in general, because STRD is going to open up a channel to the high yield markets, and that capital will flow from the high yield markets into the Bitcoin ecosystem. And the more capital that we're able to raise to buy Bitcoin, the more accretive it is to Bitcoin and the price of Bitcoin. And of course, that feeds back to the value of our Bitcoin assets, which is beneficial to our common equity, beneficial to the value of the strike conversion rate, and beneficial to the BTC rating, and the collateral coverage for STRD, for strike, and for strife, and of course beneficial to the converts. So STRD is an important part of the capital pyramid, and we view it as being both accretive to all the major elements of our capital structure, but also substantially de-risking our capital structure and giving us one more tool in our financial arsenal in order to either grow faster or to fend off any short attack or hostile activist attack to manipulate our common equity. Here we can see the market comparisons of preferred stocks. You can see preferred equity comparables. There's about $80 billion worth of assets in these ETFs right now. And on average, preferred equities are yielding 6 to 7%. And they've got a fee that ranges anywhere from 40 basis points to 85 basis points. The high yield bond ETFs, they generally have yields of 7 to 8 handle. And of course, the loan ETFs, they have yields of 7 or 8. They all have fees. Of course, STRD will come without a fee. So we're not going to have a fee. And, assuming that it comes at or around par, it's going to have a much higher yield than any of these instruments. And so we're optimistic about our opportunities because there are already, as you can see, tens of billions of dollars of capital invested in instruments that are yielding substantially less with much higher fees in the market today. And as I said, Stride is building on our ecosystem. And this slide illustrates that strategy enables a wide variety of securities, all based on Bitcoin. If you want just a baseline Bitcoin exposure, you're going to buy the spot Bitcoin ETFs like IBIT. And there's about $140 billion of spot Bitcoin ETF in the market worldwide right now. Our approach is we take advantage of our Bitcoin reserves and we use them as collateral in order to collateralize or back or provide performance for a variety of securities. Our convertible bonds are providing one sort of exposure with a credit protection and a different flavor of volatility, less volatility, more credit protection. And as Phong showed, the bonds are actually delivering upside that is in excess of Bitcoin, but with a credit instrument. BMAX is an example of an ETF that is buying those MicroStrategy or MSTR back convertible bonds. Strike, Stride, Strife, they're all intermediate in the capital structure. If you want a convertible preferred that's a slightly lower delta instrument that's got a dividend, then you could buy Strike. Stride will be our high yield fixed preferred. Strife will be our senior, targeted to be investment grade fixed preferred. Then you can see at the bottom of this stack, you've got MISTI, iMist, and MST. These are actually examples of ETFs that are simply selling volatility. They're attempting to generate the highest possible yield, selling volatility all the time. Above MSTR are MSTX, MSTU, MSTZ. These are examples of 2x levered derivatives they're 2x long MSTR or 2x short MSTR to provide more volatility, more performance. And of course, if you want more than 2x, you would go to the options market, which is quite substantial right now. What makes our company unique is that we have this very liquid, very volatile, reasonably well understood, durable, credible BTC-backed equity instrument, that is the MSTR common equity. And it is the core amino acid or a building block for building these high volatility, high leverage securities in the options markets and the ETFs markets. And it's also the building block we use to create convertible preferred to generate income or to generate cash flow to pay dividends for fixed preferreds like STRD or STRF. And so we have emerged as unique in that way. I will emphasize again, what makes this possible is our substantial Bitcoin reserves, 580,955 BTC right now. There's a tendency to think, well, those reserves aren't doing anything. Well, they're definitely doing something. The reserves are what collateralize the preferreds. They collateralize the bonds. The reserves are generating the performance. They're generating the volatility and the liquidity for the common equity. So we like their role in that, and our ability to issue certain amounts of preferred. If we want to issue a preferred stock with a BTC rating of 10, then obviously with $61 billion worth of Bitcoin, you could see that we would be capped at no more than $6 billion worth of that instrument, assuming there was nothing senior to it. So the size of our reserves will ultimately control the amount and the rate at which we can issue other securities. And of course, as Bitcoin grows, the value of the reserves grow, and that gives us more flexibility with the issuance of our various preferred instruments. And that has to be put in context versus the entire rest of the S&P 500. As you can see right now, if you take the S&P index and you extract the financial services companies, then strategy is number 11 in terms of treasury side. So we have grown rapidly up the treasury stack. What is unique about us? Not just the rate at which we're going our treasury and not just the absolute size of the treasury. What is unique is that our treasury is $61 billion of digital capital, right? We are substantially all with 99.9% Bitcoin, which means our treasury has Bitcoin performance and our treasury has Bitcoin volatility. And that means that we can create this equity and these preferred equities, and we can absorb and either damp or amplify, as we choose, the volatility and the performance of BTC. And that's fairly unique. And that makes us positively polarized capital. We're attracting capital at a fairly rapid rate right now, and we expect we'll continue to climb up this treasury ladder, in due course. Slide 30 underscores our view toward credit and credit risk. And so we have created a metric called BTC risk. BTC risk is the probability of being under collateralized on a BTC basis over a given time horizon. So if you use a 1-year time horizon in this case, and if you were 3x, had a BTC rating of 3 and vol was 60, then you could see there'd be a 6.29% risk over at the end of 1 year, you would be under collateralized. You can see the risk increases as the vol increases and the risk decreases as the BTC rating increases. And this, makes sense. If I have $10 for every $1 of a liability, then the likelihood that BTC trades down 90% is fairly low. You can see even at a 70 vol that pops up on our chart here at 16 basis points. If you take this structure, if you calculate BTC rating, and then you apply statistical modeling, and then you apply the duration of the credit instrument, you can start to develop a very specific, precise BTC risk for every credit instrument, for every given duration. And so you can see on this slide, we've laid out the capital structure of strategy as of March 16th, 2025. And this is just before the Strife launch. And you can see for the Bitcoin price at the time and a 50 vol, and assuming you were a skeptic and you assumed a 0% BTC ARR, we calculated the BTC risk of this entire structure, and we calculate the BTC credit of this structure. And you can see our securities range from a rating of 41 all the way down to 4.6. Now, let me fast forward to May 30th. And this is the capital structure today, or as of this deal. The BTC price has changed. The volatility input still 50%. The outlook is still skeptical. We're assuming 0% ARR over the next decade for Bitcoin. But you can see that the BTC risk numbers fall dramatically for the bonds, anywhere from 0 to 7%. And that means the BTC credit numbers fall dramatically. And of course, you can calculate the market credit spread. That is, how are the bonds priced right now? And then you can calculate the premium. And you can see that in some cases there are large premiums. In some cases there are small premiums. So the market sets the price. This model implies a certain BTC credit. And if you believe the model, then there's a spread premium. And of course, you can calculate the same thing for Strife and for Strike. And the most important observation from this page is that all of these instruments trade with a spread premium. That is to say, the BTC credit is lower than the market credit spread. And that means the market doesn't appreciate Bitcoin as collateral the way that you might if you embrace this BTC statistical model. Now, if you're a Bitcoin maximalist and you believe that Bitcoin was going to appreciate 30% a year, ARR, that changes your view of risk dramatically, because you can see, even plugging in the same volatility and the same Bitcoin price, if your outlook is bullish, then the risk of all the bonds collapses to less than 1%, collapses to 0% rounded, to the nearest integer percentage. The risk on the preferreds also collapses to 1%. Of course, the BTC credit falls to just a handful of basis points. Of course, the market credit spreads stay the same, and you can see the spread premiums dramatically expand. And so for a skeptic, you might price these bonds much lower. If you're a Bitcoin believer, then these preferred instruments and these convertible instruments would potentially be much more valuable to you. If you don't want to embrace a Bitcoin-backed credit model, if you're not interested in using BTC vol, BTC AR, BTC rating in order to drive to a BTC credit number, another way to do this is to utilize the Bloomberg corporate default risk model. And so we actually created that here, and we're showing you the results of that for MSTR. And of course, it's driven by volatility, and you can see that as the volatility of MSTR falls, we move from a high yield rating to more of an investment grade type rating here. Of course, you can go ahead and plug in your own number and decide what kind of risk would be appropriate. This shows a 5-year probability of default. Coming back to the question of how do we pay the dividends, you can see here that Bitcoin has traded $54 billion average trading volume over the past 30 days. So BTC is very, very liquid. MSTR's average trading volume is about $5.6 billion a day. So not as liquid as BTC, but an extremely liquid instrument. Our annual fixed obligations, about $235 million. You have to compare that to the equity we've raised so far year to date. That's $9.1 billion. And so the total fixed obligations we have as a percent of daily trading volume, 4%, 4.2%. As a percent of the last 12 months equity that we've raised, about 90 basis points. And as a percentage of the last 12-month trading volume of MSTR, 2 basis points. So we feel confident that we should be able to raise the capital in order to pay these dividends without stressing any part of our capital structure. Slide 36 illustrates the credit spread of traditional bonds. We're currently engaged in a process of educating the market about the creditworthiness of Bitcoin-backed credit instruments, and Bitcoin-backed credit instruments are a fairly new thing. The traditional market is very familiar with fiat-backed credit instruments, and as you can see here, normally credit spreads for investment grade are anywhere from 30 to 125 basis points. And, as your credit rating falls, these credit spreads increase to much larger numbers. We're confident over time that we will persuade some investors that are Bitcoin believers to start to think more seriously about Bitcoin as collateral. And as they start to embrace BTC ratings and BTC risk and BTC credit metrics, then we expect that our fixed income instruments and our preferreds will be re-rated by the marketplace. And so there is upside, and we're enthusiastic about our education efforts to get the market to view us as an investment grade company, issuing some instruments that are investment grade type instruments or comparable to investment grade type instruments. On slide 37, you can see why we believe this. Because the lowest collateralized instrument we have is going to be 6 times over collateralized, and the highest seniority instrument is 60 times over collateralized. And if you look at the conventional capital markets, there is no rated U.S. company that is more than 3 times over collateralized on their fixed income securities. And so in this particular case, we think that we're pioneering a new area, super over-collateralized credit instruments. And so they're not rated right now, and the credit rating agencies have not embraced Bitcoin as collateral. But clearly, this is the opportunity for our common equity shareholders and for our fixed income investors. And this is an opportunity for the market and the industry in general. And you can see we have good reason to be optimistic based upon this table. So let me end with the thought that STRD, it's going to be driven by BTC coverage. As the price of Bitcoin appreciates, the BTC rating is going to appreciate. That means the credit risk perceived in the instrument should decrease. That means that the credit spread should compress. If the credit spread compresses, then STRD can trade up from whatever level we initially sell it at. So that would be credit positive for STRD. We think that because it's a very long duration instrument, if interest rates fall, if SOFR falls over time, that could be very beneficial to STRD because we have a long duration fixed dividend. And then, of course, as Bitcoin volatility changes, an increase in volatility of BTC would increase the risk, but a decrease in volatility of BTC would, of course, decrease the BTC risk, and that should be credit positive for this instrument, should compress credit spreads over time. Our belief is Bitcoin has been growing 50 to 60% a year, and over the course of 20 to 30 years, my belief is Bitcoin grows about 29% a year over the course of 20 years. And as it decelerates from its 55% growth rate down to, say, 20%, we think that the volatility, at least I believe the volatility of Bitcoin will also decelerate and should fall from 55 down toward the 20 level. And of course, it'll take two decades for that to happen. But over time, as Bitcoin emerges as an institutional grade asset class, it's very reasonable that its performance begins to converge on the S&P index or some equity capital markets number. And it's reasonable that the volatility begins to converge in the same way. So whatever happens, the important thing is that in a high volatility environment, that is equity positive for us. Higher volatility increases the value of our equity instruments and the derivatives and the options that trade above the Bitcoin baseline. And that gives us the option to strip the volatility to sell the credit instruments. And on the other hand, in a lower volatility environment, we have more creditworthy instruments, and so it's reasonable that we could increase our leverage ratio. And so the company is pretty well positioned to either run with a lower leverage ratio on a high vol environment or a higher leverage ratio in a lower vol environment. And we can tune this over time in order to ensure that we reach optimal performance with our equity and with all of these other instruments. And I will just end just reiterating the terms. It's pretty straightforward. $100 par, 10% dividend at par, junior to the other preferreds. Our appendix has some nice details on our assumed fully diluted share count. And also, there's a more detailed explanation of how we view BTC yield, BTC gain, BTC dollar gain, and also how we view BTC rating, BTC risk, BTC credit metrics, etc. So if you have questions about that, feel free to read the details in the appendix. And we thank all of you for your time today and for your interest in this offering.